Hi, Doug Andrew again. In this episode, you're going to learn how to answer questions for your prospective clients, such as why borrow my own money in an IUL instead of withdraw it? Now, I usually tell my prospective clients, well, I want you to do what millionaires and billionaires do, and I get their attention. So if you don't know what I'm talking about, it's understanding how money really works. So let me frame this and help you understand how to explain this to a prospective client so that they get it. You know what takes the time in learning? Not getting it. See, the objective of these video series is to help you get it. I want to get gotten, okay? So it's getting gotten, and when you talk to a prospective client, you want to get gotten. And so you have to use metaphors, stories, examples, and help them understand the concept. Take complex things and make them simple. So when we talk about this concept of, hey, why is it smarter to borrow instead of withdraw? In the last episode, you learned that I can do a zero-wash loan, and by borrowing, it's a phantom loan. The loan is not due and payable during my lifetime. It's washed away when I ultimately die with a tax-free death benefit that is increasing with the cash that I didn't withdraw, because it's growing. Even though a loan balance is growing, this is growing as fast, or I'm going to show you how to have it grow faster than the loan balance. This minus this equals the same amount you would have had you pulled it out the dumb way. Now, let's review. There's only 3 types of income Americans pay income tax on since 1986 tax reform: earned income, passive income, and portfolio income. Earned income is, salaries and wages and so forth. Passive income is like rents and leases. Portfolio income would be interest and dividends and what have you. If you have income that does not fall under those 3 definitions, there's nowhere on a 1040 tax return to put it. It's tax-free. It's that cut and dried. You wouldn't believe how many people don't understand what I just explained to you. So that's why a loan proceed is not taxable. If you borrow money for a house or for a car, you don't have to pay tax on money you borrowed. So when you borrow out of your insurance policy, you're using your policy as collateral, and it's continuing to grow. And as it grows, you might have this loan balance, but this growth here totally compensates for this loan balance that's growing, and the net left over is as much or more than you would have had you pulled it out the dumb way and paid unnecessary tax. So hopefully you got that in the last episode. So let's talk about really the smartest way to access money using a participating loan or an indexed loan. They come with different names, and I want you to understand how this works. Now, in reviewing how money really works, banks, credit unions, insurance companies, they pay us interest. There's 4 things that you can do with money. You can spend it, lend it, own with it, or give it away. Now, when we have our money in a bank account or a credit union or even an insurance company, it's in a lended position. They are borrowing our money. Now, are they just a benevolent institution paying us interest? No, they don't put our money in a vault and pay us interest. What do they do with our money? They put it out and invest it. They loan it back again. A bank will borrow our money at 1 or 2%. Right now, it's pathetic. And then they'll turn around and loan it back to you to buy a house at 4, 5, 6%, or to business owners or what have you. I've already mentioned that in 2008, when 400 banks went under and 900 more were on the watch list, the federal government asked the 5 major banks in America to disclose where they had their Tier 1 assets for liquidity and safety in case of a run on the bank, a financial collapse, because we came pretty close to that in 2008. Guess where the 5 major banks have 30 to 40% of their Tier 1 assets? In BOLI. What's BOLI? B-O-L-I, bank-owned life insurance. People go, what? Yeah, see, you've learned that the owner of the insurance policy gets all the tax-free benefits and income and everything else, and so they own life insurance on people. And so the banks realize that if they take money and they borrow it from us, let's say we collectively put $1 million into a bank down the street. And they're paying 1% interest, which is sometimes the best they've done in recent past. And so 1% on a million, they're going to shell out $10,000 a year in interest to us to borrow our money. And then what do? Well, they disclosed they take about 30 to 40% of their tier one assets in case of a run on the bank, and they invest it into the multi-trillion-dollar insurance industry and the legal reserve insurance industry. Now, the truth be known, most insurance companies are ranked 5 or 6 notches higher in safety than most banks and credit unions. A lot of banks are only rated triple B by Standard & Poor's or Moody's or whatever. And the insurance companies where I put my money in IUL are usually rated triple A. So the banks are taking our money, paying us 1%. They're increasing the safety by 6 notches and increasing the rate of return on just the general account portfolio at 5%, let's say. How much more is 5 than 1? Don't say 4, okay? It's 500% more. Would you hire an employee for 10 grand that made you an extra 50 grand? Would you buy a widget machine for 10 grand that made you an extra 50 grand? What's that called? That's called a 500% return on equipment cost or employment cost. So the banks are making 5 times, but it's actually an infinite rate of return because it's not even their money. They're borrowing OPM, other people's money. So this is what makes the world go round. If you haven't figured this out, borrowing money at a low rate and earning a higher rate, that's called arbitrage. But it's as old as the Bible, okay? I'm Christian, and I taught the life of Christ for 8 years at an Institute of Religion. And one of my favorite parables is in Matthew 25 and also Luke 19. It's the parable of the talents and the parable of the pounds. And, you know, the harshest words in the Bible were spoken to the person who did not multiply their talents. I mean, that kind of wording was not used with the woman taken in adultery, but the one who did not multiply his talents, thou wicked and slothful servant. I'm going to take it away from you and give it to the one that has 10. And of course, the crybabies in life have been, oh yeah, then what has gets. No. You're supposed to take what you are blessed with, your talents, and multiply them. If you remember in the parable of the pounds, the master said, you should have taken your talent, instead of burying it, put it in a napkin. You should have put it in the bank with usury. What's usury? Okay, it's higher interest. You should have taken the money and put it in at least the bank and earned more, had it compound, had it grow. Because you just buried it, you're a wicked and slothful servant. I'm going to take it away from you. See, this is as old as the Bible. And so when we understand how money works, it's really what makes the world go round. When you have an insurance policy and you have cash value and you want to borrow, what I do with my clients is I go, okay, what kind of an economic or market situation are we in right now? Now, if a terrorist attack just happened and we're headed for a major recession for 2 or 3 years, I'll say, you know what, let's just do the zero wash, zero cost loan until the economy is back growing, vibrant, and dynamic. It's that way probably 70% of the time. So that's when I say, let's do an index loan. Let's do a participating loan, because every year you can switch between the two. Did you hear that? You can switch between the fixed zero wash loan and the participating index loan every year based upon what the economy is doing. So let's talk about what an indexed or participating loan is. That's where I am telling the insurance company, okay, I know you'll loan me the money, zero cost. You charge me 2% over here on the loan balance, and you credit me 2%. It's a zero cost. But I would like to, on this cash value that I'm not withdrawing, to have it continue to compound. But I want it to compound. The amount that is collateralizing my loan, I want it to earn, 7, 8, 9, some years 15%, 25. I want it to participate in the index. I want the whole cash value. In other words, the collateral that's collateralizing the loan. The insurance company will do that, but they have to charge a little bit higher interest rate. They may charge 4.6% or 5%. So if you choose a participating or index loan, they charge you 5% on the loan balance. You don't have to write out a check. It's automatically deducted from this balance over here. But now this balance can grow at 7, 8, 9, 10, 15, 25%. Why do I do that? Because I know that 70% of the time this is probably going to earn at least 2% higher than this. And that's just the way money works. If I borrow at 5 and earn 7, that means I can actually access 2% more on $1 million. If I was only earning 8%, that's $80,000. But now I can pull out $100,000, 2% more because of this arbitrage. Because they're charging me 5 and I'm earning 7. It's not a wash. I'm earning more than they're charging me. Now, this is incredible. I want to share with you why this is so important to understand so you can explain it to your prospective clients. Now, not only in 2008 did the banks disclose that they put their money in BOLI, bank-owned life insurance, but the major corporations were also doing that. It's called COLI, C-O-L-I, corporate-owned life insurance. That's where I have my corporate assets for liquidity and safety. And I keep money in there. And if I have $1 million of cash value, business owners use that as working capital. And they use these index loans to be their own banker. You maybe heard of that concept. So how does it work? If you're a business owner, if you're retiring, it doesn't matter. If I want to access my money the smart way and the economy's doing well, I will opt for the indexed or participating loan. It comes in one sheet of paper. When a client calls and says, hey, I need some money out of my policy. Now, most of them already, I need to borrow money. They know that. They've been educated. They've read my book. They've been to seminars. And so I'm going to use an example and tell you a story of one of my clients who's a business owner. This gentleman, he makes his money by buying distressed apartment complexes or even strip malls. And the seller just wants out. They don't want to reinvest in it. He buys them and fixes them up and then sells them to a pool of investors that are looking for renovated properties. He doesn't want to be the landlord. And so he will find properties, and sometimes he will call me and say, Doug, I need $1 million. I need some earnest money to tie up this $25 million apartment complex. And so he says, send me over, email me that form. So let's say he has $1 million in his index universal life insurance policy. So he gets the form and he puts his name at the top. He puts his policy number, which is like an account number. And then it says, do you want to withdraw, partial surrender, $1 million, or do you want to borrow $1 million? Which one do you think he checks? Borrow. Yeah, he's smart. He's a business owner. So he borrows $1 million. And he usually does the indexed loan because they will charge him 5%. So that would be $50,000 on $1 million. He doesn't have to write out a check for that. He can, but he doesn't have to. Why? Because the money over here, the $1 million, is continuing to be credited with the indexed rate. So he knows on the average, based on history, he'll probably be charged 5, but he'll earn 7. He'll be making $20,000 a year on his money over and above the cost while he's using it for something else in his business. Did you understand what I just said? Well, let me tell you what happened in 2017. He needed $1 million and he borrowed $1 million at 5%. Do you know what the $1 million did in his policy that was collateralizing the loan? And he had one policy, he got 16% that year, the other one 25%. Okay, let's do the math. The insurance company loaned him $1 million. He used it in business. He was making a ton of money on that. While he's using his money, it's still earning interest over here. His $1 million made $250,000, 25%. He made $250,000 over here, even though he pulled his money and put it over here. Now, the 250,000 minus the 5%, the 50,000, he netted 200 grand or 20% tax-free on his money that year while he was using his money for something else. Did you hear what I just said? This is incredible. And that's why I use the index loan or participating loan, because you continue to earn the indexed rate. And generally speaking, you should earn 1-2% higher. Some years you may not. Some years you don't earn anything. But on the average, what you're hoping is that this is going to earn higher than the charging rate. Otherwise, if we have a recession, you just go, oh, let's switch over and do a zero wash loan for a couple of years until the economy picks up again. It's that flexible. I want to share with you one last concept that most insurance agents do not understand. Are you ready for this? Let's say you have a client that's retiring. They have $1 million of cash value, and let's say we're going to pull out 10% a year. Hopefully you're learning here that you could only be earning 8%, which would be $80,000 a year of income. But by borrowing it out with an index and earning 2% higher than they're charging you for the loan, people can pull out $100,000, even though the policy is only being credited with 8% because of the arbitrage, because they're borrowing at 5%. Does that make sense? And so let's say he pulls out $100,000 a year, and you do that for 20 years. 20 years times 100,000 equals what? $2 million. Now, if you looked at his ledger in the 20th year of retirement, he has $2 million of phantom loan plus the accrued interest, okay? But he has this over here, which has been compounding and growing much higher than this. So this is more than this. And all of a sudden, he sells his business, he inherits money, he comes into a windfall. You wouldn't believe how many times this happens. And people come and say, golly, Doug, I have $2 million in a lump sum. Golly, I'm not healthy enough to qualify for another IUL policy. I'm too old and I have a few health issues. And same thing with my spouse. And oh, doggone Congress, they're not as attractive anymore. I wish I had another index universal life. What's the next best thing? And I go, you're in luck. What do you mean? Well, you're grandfathered. See, those new tax laws, whatever they were, they don't apply to you. Your policy is grandfathered. You operate under the laws that existed back then. Remember I told you the loan is never due and payable during your lifetime? Yeah. Doesn't mean you can't. Why would I want to repay it? You're really not repaying it, you're reinvesting $2 million new dollars back into your insurance policy. The insurance company considers it new money. It's $2 million coming in new. The IRS says, oh, you're just repaying a loan. Even though you don't have to pay the loan back, doesn't mean you can't. So you put $2 million back in there and he hits the ground running. 10% a year is 200 grand. He starts right off the bat pulling out 200 grand a year tax-free. Does he have to comply with TAMRA? No. That was met years ago. He can throw that money in a loan repayment and instantly, in huge lump sums, start making a rate of return and taking tax-free income. He doesn't have to wait 5 years and jump through all those TEFRA and TAMRA hoops. This is an unbelievable strategy so that people can be grandfathered to reinvest down the road by simply repaying a loan if they want. Hopefully you've gotten some epiphanies and ahas in this episode, because this is complex enough that a lot of people simply don't understand this. You wouldn't believe how many insurance agents do not understand what I just explained. So this is really a safe positive leverage where you're able to borrow at a lower rate, earn even just a slightly higher rate, and increase your cash flow dramatically. So if you haven't put two and two together, I've been teaching you how an insurance company on a general account portfolio only earning 5% can afford to pay you 8% because you're giving up the interest on that for them to buy upside options, and they credit you the indexed rate. And the trade-off is that the market loses, you don't lose, but you're able to be credited 7-8% or more by using indexing, even though they're only earning 5% if they just leave their money in AAA and AA bonds. But I just explained to you how an insurance company, if they credit you 8, can pay you 10. They can pay you $100,000 a year on $1 million instead of $80,000 based upon the smart way you're accessing it. Because if I pull it out at 5 and I keep earning 7, that's 2% more that I'm earning than they're charging. Now, sometimes even CPAs, when they hear what I just said, sit there with this deer in the headlight look and they go, how come I've never heard of this before? Well, they're not taught this, unfortunately, when they get their license. A tax attorney is not taught this when they get their LLM degree, which is a master's in taxation. Now you know, and you know more than most of those advisors do. And what does that mean as far as how you're viewed by your clients? You are a tax strategist.